And sorry for taking last week off. My son was just recently born, and we're spending some time with him, obviously adjusting to a new lifestyle. So a lot has happened in the last 2 weeks, definitely in the market, real estate market, interest rates, and obviously if you're following stocks and crypto, what's been going on. So I'm going to take you through some reports that have come out this week, this past week from Desjardins, also what we're hearing from RBC. And what we're hearing about inflation, what we're seeing about how Canadians are reacting to obviously services and goods prices going up, and obviously what's going on in the rental market. So stick around, there's a lot to cover, and there's so much going on every single week, so you definitely want to subscribe. Any likes, any comments, guys, please leave it below. I also have my Twitter handle and Instagram below if you have any questions for me. And again, I am a wealth management advisor, and you come to my channel here to get your information on macro, interest rates, and real estate as well. So if you subscribe, I always appreciate it, and obviously it goes a long way in terms of continuing to provide these videos on a weekly basis. So let's kick it off here. We start off with a report here from Desjardins. The housing correction gaining pace to continue throughout next year. And this is from Desjardins, who released his report this past week. As you can see, this article is from August 11th. Desjardins is forecasting the average home price in Canada will decline by nearly 25% by the end of 2023. And that's from the peak of February 2022. And what I want you to take away, 25% they're saying in the national prices. We've already seen some 25%, 20% decreases here in the GTA, for example, in Brampton and certain regions of Durham. So they're talking on a national level. So definitely take that into account when you're reading this article or reviewing this information. In its latest residential real estate outlook published on Thursday, Desjardins says is expecting a sharp correction in the housing market, adjusting his previous forecast where it predicted 15% drop in the home prices over the same period. Desjardins says the worsened outlook stems from both weaker housing data and more aggressive monetary policy than they anticipated. The report also noted housing prices have dropped by more than 4% in each of the 3 months that followed February, when the national average home price hit a record of $816,000. That was in February 2022 when that price hit. Despite the adjustment in the forecast, prices are still expected to be above pre-pandemic level at the end of 2023. So Desjardins is obviously seeing changes in the market since February. They're expecting this to continue to 2023, end of 2023. But I think the statement is important. They're expected to be above the pre-pandemic level at the end of 2023. So some of those gains may still stick around. Again, it's really going to be dependent on where you reside and what region you potentially looking to purchase or sell in. Continuing along the same line, RBC has said a lot on the real estate market, and I shared some information with you about 2-3 weeks ago. This is an article here from Monday, August 8th. Toronto, Vancouver housing markets face deepest decline in 50 years, and this is from RBC. The toll that rising interest rates are taking on Canada's housing market became even more apparent this past week, according to RBC, as reports from local real estate boards reveal the downturn was deepening from coast to coast. Prices are sliding fast, and the exuberance that was in the market and pre-mated these markets early this year is being replaced by fear. And this is from RBC Assistant Chief Economist Robert Hogue in a recent note. Apart from the housing or diving house in the early COVID-19, home sales in Toronto have fallen to the slowest pace in 13 years. Meanwhile, inventories are climbing quickly, up 58% from a year ago, and buyers are now managing to get meaningful price concession from sellers, he said. Since March, the composite MLS home index has shedded 178,000 or 13%, falling to 1.16 million. In July alone, prices decreased 3.9% or 47,000. Toronto is not a buyer's market yet, according to the sales to new listings ratio, but RBC expects home hunters in the GTA to continue to find better deals, especially in the 905, as I was mentioning, Milton, Durham, Peel. Those prices have already gone down. Areas outside of the core, while prices soared during the pandemic. Also with Vancouver, where home sales are down 40% in the past 4 months, is also experiencing a big chill. Home prices have fallen 4.5% since April, or more than 57,000, but RBC thinks the correction here is still in the early stages. It expects prices to fall more rapidly in the coming months, especially in the detached home sector. And a little bit here about Montreal. Home sales in Montreal this year have been slowing gradually, and by July had declined to 17% below pre-pandemic levels. That and a rise in inventories have returned the market to balance. So you have RBC, you have Desjardins saying we're in the early stage of the housing correction. they still expect further pressure on the downside for prices and home sales. So that's telling you from two biggest financial companies here in Canada what they think about the housing market. Along those lines, from the Bank of Canada, what they're obviously trying to do is a soft landing here, and I just want to share some tidbits of information with you. So this is from Reuters, August 11th. Bank of Canada soft landing scenario hits the rocks in bond market. So this is with the bond market in terms of yields and obviously inversion, but I'm not going to take you through those details, but I just want to touch very high level. Some analysts see curve inversions as predictors of recessions. Canada's economy is likely to be particularly sensitive to higher interest rates after Canadians borrowed heavily during the pandemic to participate in the hot housing market. It makes sense that we see more of an inversion this cycle than we have in the last few, just because there's so much of a central bank over tightening component to this, and that's the biggest thing, guys. Bank of Canada is expected to continue to raise interest rates. This is continue to have sellers and buyers on the sidelines, and I'll definitely talk to you about what this means for renting in terms of the prices we're seeing there. That's a direct result of the Bank of Canada's actions, and that's all due to taming inflation. And this is from Tuesday, August the 9th. So most Canadians cutting back on groceries, entertainment as inflation source. Canadians are cutting back on groceries and entertainment as red-hot inflation continues to put pressure on households. This was a survey conducted by Yahoo, and this is what they found. They surveyed about 1,500 Canadians, found that 60% of respondents set stricter priorities and reduced spending due to higher prices in July than they did in June. Among those, they're reining in spending. The top categories facing cutbacks include dining out at restaurants and ordering in, followed by groceries and entertainment such as movies, sport events, and personal sports activities. And we're going to continue to see this depending on obviously what goes on with inflation. So the most recent data from Statistics Canada shows that consumer price index jumped 8.1% in June. This is the biggest increase year over year since January 1983. Well, obviously the rise is to skyrocketing gas prices. Price hikes remain broad-based, with 7 of the 8 major components calculated in the CPI going up by 3%. And also with food prices are up 8.8% in June compared to last year. And food purchase at grocery stores are up 9.5% annually. And that's compared to last year. The price of fresh vegetables jumped 9.5%, dairy products 8.7%, and meat increased 8%. So the rising cost of food has already forced a majority of Canadians to cut back to just the necessities, and this is according to this poll. So again, this article will be in the description below, so if you're curious to read up, definitely have a look. But again, this is one of the biggest themes of 2022 stemming from last year, that inflation is obviously something Bank of Canada and the central banks need to get a grip on. And now we're reacting in terms of what we're going to do to cut back on our expenses and make sure we are able to afford our balance sheets and make sure we have some cash flow. And as a direct result of inflation, interest rates increasing, and what's going on in the housing market, we're seeing here for rental. So you can see here, great for landlords, horrible for renters. How a runaway rental market has become Toronto's latest housing market, or nightmare I should say. And this is from Tuesday, August the 9th. So Shiv Kanal and his 3 friends have been looking for a house to rent in Toronto since July. The group of young professionals has found several that fit their needs. The only problem is they're getting outbid 3 times in a single week at one point. We're getting tired of viewing about 10 homes, like a couple of them, and then losing out on the ones you like to someone who bid you $300 or $400 more, Kanal said, explaining that he and his friends have started to overbid listings in an attempt to secure a place so they can move in by September. Last week, Hall's group told the landlord they'd be willing to pay $4,000 for a 3-bedroom house that's listed for $3,600 plus utilities per month after being asked for their best offer. The rental ended up going to someone else that offered $100 more. So you can see people are now battling each other for rentals, and that's a direct result of individuals not being able to afford, buy a home, and that's because of mortgage rates, and obviously what's a direct result of interest rates. So overbidding for rent is not new, but it has become more common with the current hot market, in which rents have surged more than 20% since, some cases since this last year. And this is just some commentary. Market watchers say that interest rates rising, many Canadians who were planning to buy homes are now thinking twice due to market uncertainty, or realize they're no longer able to afford to buy and are flooding back to the rental market. So this surge in demand has caused absolute havoc. So what we saw with housing prices last year and inventory is now happening with rentals, and that's obviously direct correlation of interest rates. So guys, I hope you appreciated me coming at you on a weekly basis. The three biggest things I want you to take away is Desjardins and RBC definitely see us in the first legs of this housing correction. They expect more to come and you want to adjust accordingly. Second is the soft landing inflation. We're going to see how it plays out in terms of interest rates, but do expect interest rates to continue and Canadians and companies continue to react according to that. And the third is if you're in the market for a rental, you're definitely going to have competition. You're definitely going to pay more than you expected. So definitely take that into consideration. So guys, I hope you appreciated it. Any comments, any questions, please leave them below. Any subscriptions or subscribing to this channel will be much appreciated as it definitely keeps me going on a weekly basis. So have a great week ahead of you and talk to you soon. Thank you.